Um, so what I'm going to be covering today is how have real data benchmarks become a factor in the definition of what constitutes sustainable finance or a green investment product. So we'll look at the current backdrop. Where has all this stuff come from and where are we right now? I'll look at the implications for asset owners, for the miners themselves, because obviously, ultimately, the idea here is that these sustainable finance initiatives are a means of tying together global and national objectives on things like net zero to investment plans and to guide the financiers and the owning companies that actually put those funds to use. And then I'll talk a little bit about the future and where this might be going and some of the things that could be working in its favor or could be working against it. To give you a bit of background on sustainable finance taxonomies, they're classification systems that define what economic activities are environmentally sustainable. So that's the idea behind them. They're quite distinct from other frameworks in that they're not limited to, for instance, reporting guidelines. They quite often include quantified benchmarks based on real world data, which is where Skarn comes in, especially relating to things like carbon emissions intensity. And I'm not really going to touch on water today, given that there is still a lag there in terms of the incorporation of water metrics in these taxonomies. But things like emissions intensity are built into taxonomies at quite a fundamental level in some cases. And we've contributed data towards the development of some of them. And it seemed like a good idea to explore the topic. So hence the reason for the webinar today. In particular, I'm going to look at the Australian Sustainable Finance Institute's taxonomy as a reference point. We contributed some benchmark data on lithium, nickel and copper emissions intensities to that project quite recently, and those have been incorporated into the taxonomy. It was developed over the course of last year, 2024, in collaboration with the Climate Bonds Initiative. It went through a couple of rounds of public consultation and then was delivered to the Australian government for approval at the end of February last month. The aim of that taxonomy, like many others, is that it aims to align investment with the government's plans to get to net zero by 2050. And it does that partly by setting thresholds and declining targets for emissions intensity. The intention is that it's useful for both financial institutions and asset owners, so that there's an independently derived roadmap to steer by. So what's the history then? And taxonomies or sustainable finance definitions have been around for a while, initially as in-house or proprietary initiatives within financial institutions. And the first ever green bond was actually issued in 2007 by the European Investment Bank, followed by the World Bank in 2008. So it goes back now well over 15 years. These bonds aimed to finance climate and environmental projects, and as these kind of the green bond concept gained popularity, the lack of standardization in terms of how do you define something as green and avoid greenwashing became an issue. So in 2013, a group of banks, included the likes of Bank of America, Citibank, Credit Agricole, JP Morgan, worked together to create a set of voluntary guidelines for green bonds. And those banks published the initial green bond principles in 2014 and those were adopted and then governed by the International Capital Markets Association, or ICMA, from 2015. So there was a more global consistency applied then to those principles. From there's been an evolution in terms of how those taxonomies have developed, a gradual move to making these guidelines mandatory in some jurisdictions, although interestingly that hasn't gone that wide yet. And also interestingly, China was the first country to adopt a mandatory taxonomy, followed by the EU. Typically for the EU, their taxonomy was rather complicated. and is now in the process of being simplified. Elsewhere, national taxonomies are not yet mandatory, or in many cases even in existence. So the US doesn't have one. The UK does. Brazil is looking to integrate one, but they don't necessarily figure as priorities for developing countries for reasons I'll go into. So before we get into looking at how the proposed Australian taxonomy works, I wanted to just back off a little bit and look at the global picture in terms of emissions as quantified by Skarn for our sector. I'd also put that into a bit of a global picture as well. So what we can see is that in 2024, emissions from our sector, so from the commodities I'm covering on this slide, which is the bulks, the precious and the base, grew by 2.5% year on year. And that was really reflective of what happened to emissions at the more global cross-sector level. And the point I wanted to make here is that if the world's going to meet its 2050 targets, back in 2021, the IEA pointed out that emissions would need to decline from the 34 gigatons in 2020 to 21 gigatons in 2030 to be on path for a net zero in 2050. And the point I'm trying to make here is that thus far, emissions globally in our sector and more widely have gone in the other direction and are now globally at 37 gigatons. So there's no reason to think that a 40% decline in the next 5 years is going to be feasible. And we're still seeing growth in emissions from coal, albeit not from our sector, but we still have some way to go, to say the least, in order to get back onto some kind of pathway towards net zero. Just to give you a little bit of insight here, from the commodities we cover, we've seen the biggest emissions growth from metallurgical coal, mostly from a reevaluation of methane emissions. Also, we've seen significant increases from lithium, given the increase in hard rock lithium production and the requirement for that to go through a very energy intensive, hydrocarbon intensive downstream refining process and roasting process. So right now, things are not heading in the right direction, was really the point I wanted to make. So coming on to how a taxonomy works, I'm pulling as an example here the approach to lithium set out in the Australian Sustainable Finance Taxonomy. And the idea here is that they have taken our benchmarks for lithium emissions, specifically the 20th percentile of emissions on a scope 1 and 2 basis at the mine site, and use that as a benchmark for setting a pathway forward to net zero in 2050. So if we look at the 2025 threshold that they've set in the taxonomy for emissions intensity at around 1.1 tons of CO2 equivalent per ton of lithium carbonate equivalent, you can see that it does indeed sit around the 20th percentile. And I've for the sake of interest, highlighted the Australian hard rock, or the larger Australian hard rock producers on the lithium intensity curve here. The interesting thing is that what they've done is they've then mapped a pathway forward based on SBTI and the CSIRO's pathway towards net zero in 2050. And what that gives you is a 2030 target intensity of 0.48, which is obviously 50% or slightly less than 50% of the 2025 threshold. So really just coming back to that point I've just made, not only are we deviating in the wrong direction away from the pathway to 2030 targets, but the 2030 target, even looking specifically at this example of lithium, looks increasingly ambitious, to say the least. So one of the questions that arises here is that it's all very well for taxonomies to set targets based on good benchmarks, which we've provided, but whether those can actually be met or not is obviously going to be a completely different matter. And I think this is one of the areas of tension in the whole taxonomy world. Moving on to look at that, some of the additional issues around that. I wanted to just highlight some of the work that we do in our Decarbonisation Quarterly around the targets that companies set. And what I'm looking at here is a slide which shows you the range in emissions intensity between the highest and lowest assets for each of the companies shown in the table here. So the idea is that although a company's average emissions intensity, for instance, Glencore's, may sit just below the middle of the carbon intensity curve, the actual range between its highest and lowest assets can be extremely wide. So it really does emphasize the importance of examining a company's emissions at the asset by asset level. It's not really very helpful to look at it on a corporate average basis, is the main point here. And then when we get into looking at the actual company targets, the interesting thing there is that some of these do indeed align with that idea that we need to get to roughly 50% of current emission levels by 2030. So some of those companies do have targets which take them to that point. Predominantly the companies which have access to power purchase agreements, which allow them to reduce their Scope 2 emissions. Reducing Scope 1 emissions is going to be the really difficult component of this. And going back to that example I gave of the lithium mines, and if they're going to conform with that Australian taxonomy, some of those mines are really going to struggle in that they're going to have some hard decisions to make and some big investments to make if they're going to get anywhere close to doing that by 2030. But the point is the corporate targets in some cases do align. Obviously, these companies have set targets with a 2050 net zero or carbon neutral or ambition in mind, so they should, in theory, be aligned towards that trajectory. But there remains some uncertainty as to whether some components of those targets are going to be delivered on, and beyond 2030, it starts to get really difficult with Scope 1 reduction being required. So that was the main content I wanted to cover with slides. But I did want to discuss a few more of the issues around taxonomies and how those potentially interplay with net zero targets and the kind of data and analysis that we produce. So coming back to the idea of taxonomies, the idea is that if we create frameworks that make sense and that financial institutions like, they become embedded. And because investors want a shared definition of what is green, these things get traction and they reinforce that alignment between asset owners and their plans to get to net zero and what the financial institutions are willing to finance. But as the Australian example shows, there's a kind of tension arising here in that if taxonomy set out a set of milestones to net zero, the performance on emissions to date is not encouraging. It's going in the wrong direction, and the targets are very ambitious. The targets that companies have set may be aligned with that trajectory, but they're going to be challenging. And if you add to that the current uncertainty about, for instance, flows of investment into ESG labelled funds and the degree to which those have fallen out of favour, and the headwinds that the industry is experiencing more generally in terms of tariffs, the uncertainty around geopolitics, there's lots of scope here for things to go sideways. And although I'm loath to say it, potential for companies to start backtracking somewhat on targets, which we're not currently seeing, but is a concern, of course. Another thing to think about here is that taxonomies may look sensible and make sense in a developed country, but in emerging markets, a taxonomy may not be that's appropriate for a developed country may not actually be appropriate for a developing country. It may be a poor fit. So thinking about, for instance, the DRC, emissions intensity is arguably much less of a concern than, say, child labour or conflict minerals. So again, there's a whole issue here with regard to is taxonomy a universally applicable good thing, or does it have its purposes in certain jurisdictions? And again, just to emphasize the fact, there's a very uncertain pathway ahead in terms of the level to which these taxonomies will be adopted in different jurisdictions as being mandatory. So anyway, thanks everybody for listening to what I've just had to say. I'm happy now to throw everything over for questions. So I'll let Derek come in and facilitate that, if that's okay, Derek.
Thanks, Mark. That was excellent. As I say to people, just to remind you, you'll see a little sort of sign at the bottom, speech bubble with a question mark in it. If you want to ask a question, please ask away. It's anonymous, and we'll answer them as we go along. There's a couple of questions coming already, Mark. The first one is, has there been any feedback on Skarn's data in the context of its use in sustainable finance taxonomies?
That's a good question. That was one of the things which really engaged with us when we embarked on this with the SFI, was we knew that there would be a public consultation component to this, and it would be an interesting opportunity for us to see what views came back about the usefulness of our data. That feedback was positive. There were many interesting questions about system boundaries. Is the system boundary that we propose or proposed for looking at emissions intensity for those three commodities a useful one? And I think to some extent there were concerns regarding what's appropriate from the standpoint of, say, an Australian lithium producer or an Australian copper miner. So there was a certain amount of to and fro there in terms of, is this an appropriate system boundary to be considering? There were also lots of really good questions in terms of, well, what's the provenance of this data? How can I be confident that the numbers are good? So we had some back and forth on that, but generally, yeah, the feedback was very good. So we're hoping that we've contributed something useful there.
Excellent stuff. Another quick question as well is can you explore a little bit more about how different the mining sector is? What pressures exist on the mining sector that's different from other sectors?
I think the mining sector is actually recognised by those investors that look or invest across sectors as being quite a difficult one to understand and to ultimately decarbonise. I think there's quite a broad recognition there that other sectors are a bit more straightforward in terms of understanding what the issues are around emissions, and then also a bit more straightforward in terms of what do you do about those emissions, how do you mitigate them. And I think the mining sector, along with things like manufacturing, is actually quite recognised as being somewhat difficult. So I think there is quite a lot of recognition out there around that fact.
Excellent stuff. Well, unless there's any other questions, I think we're almost done, Mark.
Fantastic. So thank you everybody who joined us today. We really appreciate that. As I said at the beginning, this webinar and others that we've produced recently will be available on our YouTube channel. So please get in touch with us if you would like access to that. And I would just like to say thanks for attending. Please do get in touch if you've got any follow-on questions, and we look forward to seeing you all again soon.